And welcome to the Trading Bell. Glad that you have joined us. How are we faring on when it comes to matters Africa and the investment landscape around it? And we want to have that discussion right here. And in the house, we have an amazing guest all the way from Stanbic, the Blue Place. And we're talking to Soro Ioannis Yakwabis. And he's the head of corporate investment banking right here in Kenya to shed some light on how we're faring on. It's good to see you, SJ.
Good day, Mana.
Yeah.
It's great to be here. Thank you.
Absolutely. Thank you so much for giving us time to discuss this. And a lot of people say that Africa has not been tapped yet, and there's a lot of things to tap on. But let me start from the larger landscape of view, the macro view. I wanted to ask you, how is Africa's investment landscape evolving in your own perspective? And I know there could be a lot of things, so probably this will be in summary. And which regions are you seeing that are currently attracting the most investor interest?
A very pertinent question, I think some would say, and always mindful not to make too many sweeping statements on Africa because there are so many exceptions on anything that you say.
Yeah.
Certainly easy to mask the deep appreciation of the individual countries, each with its own unique opportunities, unique challenges, market idiosyncrasies. But at a very broad level, speaking about sub-Saharan Africa, I guess in particular, I think GDP growth is a good starting point lens through which to evaluate the investment landscape. Right here where we are in Kenya, at about around 5% GDP growth, looking at neighbors growing, some of them even faster when you're looking at Tanzania, Uganda, even a couple of percentage points higher. So East Africa, definitely from a growth lens point of view, very much in focus. Moving further west, if you go to Nigeria, Ghana, even Cote d'Ivoire, are meaningful countries from an investment perspective. And then if we move further south to the south and central sort of a region or block, I'd say growth probably anchored to an extent by fairly benign growth in South Africa over the past number of years. And good to see that back up over the 1% mark.
Okay. That's a good perspective to look at it. And let me just now segue in as well, just from that larger perspective, and get deeper into the sectors and what you're observing in the sector-specific areas. What are you seeing in terms of investments or largest foreign direct investment flows? What sectors are attracting this and why?
So, Mina, yes, I'll take for this one the public sector out of it. I think because it's such a meaningful part and it speaks to the macro. So the sectors continue to be the traditional ones in terms of infrastructure, and with a very specific subcomponent on energy within infrastructure, power, energy, and infrastructure, whether it's energy transition, sustainable energy, and even traditional sources. I mean, Africa still has a significant energy deficit. But energy within infrastructure, I think, certainly is one. Mining, a very important one, continues to be as the world needs Africa's resources, minerals. And then, of course, tech and the services industry and agri even. And why? I think maybe let's select one in terms of why. Commodities, I think, gives a very good example. And I was listening to a very interesting panel discussion just yesterday of CEOs of top banks in Africa. And the one, I think, possibly most pertinent example that illustrates the point quite well is if you look at cobalt, for example, raw cobalt trading at about $800 a ton in its raw form. And then as a finished product on the LME, London Metals Exchange, that's over $40,000 a ton. So, 50x. So when you talk about, and admittedly, there's a big process there. There's from crushing and grinding in that cobalt piece, through to the beneficiation, concentration, and then the smelting of it to get to that point. Fair enough. But if you look at the low participation in that beneficiation and value chain, at 50x, you're participating as the initial owner, if you like, of that mineral endowment, you're looking at a 2% participation in the value chain.
That's true.
And so the rest goes for I guess, other resources as well. When you look at copper exported in cathode or blister form, very far from a pricing perspective to where copper trades on a market in its finished form. Refining. If you see how well Nigeria has benefited now from the refining capability in Dangote being onshored, and the positive balance of payments that's kicked off for that country.
You're right.
Significant. Growing reserves. Ghana's got a refinery. Uganda's planning a refinery. So that's just as one why in one industry in terms of the upside available. Of course, that's underpinned by infrastructure and industrialization and the like.
Wow, great examples there, and definitely there's a lot of work to be done, especially on the value addition part of it. I think the potential is certainly very huge if we can tap into that. Let me move on to specific investors, and just talking about how portfolio investors are diversifying their investments within Africa. What are you observing? Because definitely they move, and there's certain patterns definitely that come out of it. And which countries or industries are you seeing most growth in this particular ways of investments?
Mine, a very interesting question to consider as we sort of pivot from the foreign direct investment space into the financial investor space in terms of inbound capital into, let's say, the more securities type space in Africa.
Yeah.
Countries that have initially, certainly, and currently, I'd say the main ones standing out, in sub-Saharan Africa, in addition to Egypt, I guess, in the north, and South Africa in the south. The main ones that we've seen of interest from portfolio investors, if I look at the five possibly most pertinent ones, would be Nigeria, Ghana, Uganda, Kenya, Zambia.
Yeah.
And perhaps to sort of unpack that one level further, is typically your West African countries in that sense have had really attractive high notional yields. Yep. So, into the 20%, on occasion even into 30% sort of a levels. As a yield, even though there's inflation and a bit of volatility that comes with that, but attractive clearly, at a starting point for investors in terms of yield. East Africa perhaps not as high as that, into the mid-teens, but inflation well contained.
Yeah.
And relatively benign in East Africa, and so real yields definitely there for investors, and perhaps one could say. Also more currency stability. So from a both carry play perspective for portfolio investors as well as selective duration plays, has certainly shown them some reward. And Zambia, again, I think in terms of high notional yields. In terms of that, we've got to remember what these portfolio investors are looking for. So they are looking for essentially alpha, or trying to operate closer to that efficient frontier, which simply means that they are either looking for the same yield with less risk, or they are looking for higher yield for the same risk. And so Africa's diversification attributes is as a starting point really powerful, because South Africa excluded, it's not particularly correlated with efficient markets and developed markets out there. So it pretty much trades on its own dynamics, as we started the conversation with. And so low correlation to start off with. And then you can obviously diversify within countries once you are sort of in this EM space and the more investable, if you like, markets within Africa. So
let's now dive into what we hope will never be there, but the challenges must always be there, the headwinds and all that. Let's talk about the main challenges that you're seeing investors facing when entering African markets. We keep saying we want to attract as much, but hey, some of them are still seeing these blockages. What are they?
Mine, I think a risk that I'd say the traditional risk lens is a good starting point there. So if we look at some of the more traditional risk classes to start off with, credit is a good place to start. So, who's the issuer? Let's maybe for purposes of this focus on the debt markets, which is the largest and most liquid part of investing in these markets for investors. So the issuer risk, I think, to start off with. So the credit component is meaningful, and at the sovereign level, clearly you'd be thinking about debt serviceability, debt to GDP ratios as a starting point.
Yeah.
Then, in addition to that, you'll think around liquidity. So the size that I want to bring in and out of this market, what is the market impact of that sort of a size? So what is the embedded liquidity in that market? And even that, to your point, changes and fluctuates over time. It oscillates.
Absolutely.
And then I think a further lens, which is quite important, is what we call T&C risk, transferability and convertibility risk.
Okay.
So now that your investment has matured, or you need to deploy that money somewhere else as an investor, to the extent that you were in local currency, is there sufficient hard currency liquidity for you to convert that matured investment into? And, are there any regulatory restrictions of transferring that out? So T&C risk. I think those are, in addition to, one would always think around, political risk, regulatory stability and framework, some of these. But I'd say they are conditions that come after that in terms of a more holistic picture of the traditional risk lenses to start off with.
You're right. And definitely an investor would always want some predictable environments and everything else. Glad that you've mentioned the political part of it, and there could be a whole conversation on that as well.
Correct.
Let's now move on to a little bit on what I would say internal conversations and strategic roles that you're playing. I'm ready to ask you about the main areas as Stanbic that you're looking at to support investors looking to capitalize on regional growth and even navigate these risks that you've talked about. What are you doing as Stanbic?
Minor thanks. I think a question that's always fun to respond to. When I look at what the Standard Bank Group and Stanbic, as we trade as in a number of countries, bring to our customers in terms of facilitating access into and out of Africa. I think the footprint of the Standard Bank Group is a very powerful place to start off with in terms of understanding what we bring to our customers. And perhaps let me at a high level say that, where we have on-the-ground presence in 20 countries in African markets, with only 2 of them not being operated under a banking license and with a balance sheet in country. It means for the other 18 of them, we have balance sheets, which means we are actively participating in the financial markets, mainly currencies for our customers. Somebody sells those dollars, we unsell those dollars to somebody, to an importer who needs it. Then we market making to the interbanks, so as to create a larger volume so that we can facilitate even larger transaction sizes for our customers as a starting point. Then in the debt market, similarly so through our treasuries on the ground, we've got prudential requirements, our depositors' money that needs to get invested, banking books, endowment books and the like. So very active in the markets pieces of every one of those countries in which we operate as one. Then, of course, we have investment banking, advisory, debt, term debt products that our customers utilize. And then, the day-to-day interaction with clients sort of on the transactional level, transactional products and services, cash management, online banking, trade finance, trade solutions, custody. These are all parts of a turnkey offering, and that's just talking about the corporate investment banking space. We can go down all the way to the retail part of the credit curve, within that. So that being a really deep and holistic footprint, or with many points of diversification and access to our customers, You augment that then further with our international centers in Beijing, in Dubai, in London, in New York. And all of this is connected up, speaking to each other on a daily basis. And so what that system, if you like, and footprint and network provides our customers is a modular but also integrated way of accessing banking on the continent.
Yeah.
So we're a plug and play for accessing Africa to people in whichever way or form they organize themselves. So if they prefer a centralized model, they could access us through any one of these centers or countries for that matter. If they'd like bilateral engagement with on-the-ground color and presence and more requirement for the local narrative, understand that better. We've got teams of hundreds of people sitting in every one of these countries and operating full turnkey banking operations. So that's our proposition to customers in terms of, and our clients and prospective clients, shall I say, in terms of accessing Africa.
Quite comprehensive right there. I want to end by asking you one more final one, probably putting you on the spot a little bit. 3-5 years from now, I'm sure this is your bread and butter. You keep observing how Africa is faring on. 3-5 years from now, African market sectors present what are the most compelling opportunities for investors in your own perspective?
Yeah, very interesting one, and we can pick, we can pick countries and we can pick. We can pick countries and we can pick sectors.
Yeah,
I think sectors is probably the better one to answer that. And I think infrastructure and energy transition as the catalyst for infusing this growth across so many additional spheres and other sectors, I think is probably key for Africa as an enabler.
Okay. Thank you so much for your time.
Thank you so much, Mino.
Absolutely. So there you have it. We are having a conversation about just the Africa investment landscape, and you've heard it, and what really is at the frontiers and what really investors can tap into. Thank you so much for your time. That has been Soro Ioannis Yakubes, the head of corporate investment right here in Kenya, Stanbic. We appreciate you. I leave you now with the markets.